trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good morning. Happy Thursday to all of our market rebels out there. And it's that time again for Coach's Corner, but we're also early again today, Stu. Normally we're coming at you live at 4 p.m. Eastern. For a number of reasons, we had to record it early. But the big news was about NVIDIA. And we've kind of speculated that the markets were in a little bit of a holding pattern, waiting for the earnings. I saw them down about, I believe it was $5 and change, about 3%. What's it showing now?
Unchanged, down 30 cents.
Unbelievable. And that's I got a number of questions by email. I know we got a bunch of them in Q&A where everybody says, I want to hedge earnings, or I want to hedge this. And they hear that options hedge, which is true. That's what they were designed for. But unfortunately, people get carried away with that and they go, oh, I just want to get rid of this risk. And let me hedge it. But they don't realize there's a price to pay for that. And so my response was to most people, especially if you're holding the shares for long term, why bother hedging it?
Or they don't realize that they're already hedged to a degree.
If they've got a call, correct.
Yeah. Yeah.
And in the Q&A, I told most of the people in there, I said, if it were me, I'd ride through it. Look at how many times NVIDIA, over a short time, pull up a chart and look at how many times it's fallen 20% or more in a short time and then just as quickly rebounded. So you're going, okay, well, if I like the company long term, which is presumably why you're holding the shares, why do you want to hedge it every 3 months? Sometimes you have to just live with the volatility. That's what you signed up for. So it was interesting. There's a perfect example. We were looking at the puts. I think they were $7 for about a point out of the money.
They were
during Q&A. And so it was down like 5 and change. So you would have spent 7, collected 5, not worth it. And then when it's all done, right back where you started.
Yeah, that straddle went out $12, $13 yesterday.
Yeah, exactly.
So
yeah.
The big news on NVIDIA is no news.
Yeah. So anyway, what I thought would be kind of a good topic about that, we've gotten a number of questions in Q&A about this as well. We get it every year. And that is, what do you suppose this is, Stu? Should I hedge October? We get this every year because October, for anybody who's been investing for any length of time, has certainly heard that October is notoriously risky and you got to get out or you got to hedge it. You got to buy puts. But again, you have to realize that if everybody knows that, you're going to pay for that hedge. It goes right back to my analogy with a point spread, let's say in a football game. If everybody knows that team A is probably going to win by 12, it's not going to be an advantage to say, well, let me bet on team A because they have the advantage. You're going to pay for it. It gets factored in there.
And something tells me that you kind of went back and you looked at October's in the past, and something tells me that it's going to show that maybe that month was actually up
We're
over
well,
time.
it's funny when
Solid.
I always like interviewing the market makers. For those who don't know, Stu was on the Philly floor for 29 years. Specialist, Goldman Sachs, number of people. And it's one of those things that even if you didn't know the statistic of it, you just start to gain a sense from going, I don't remember it being all that risky, right? So
Yeah,
if that's kind of your gut intuition, you're exactly right. We're going to look at some slides about that.
there's always those, the crash of October. But look, I can go back 40 years, 40 plus years, and we had crashes in January and February.
Exactly, right.
You just
We're
wait
going to
with
talk
March.
about those confirmation biases. Exactly, lots of things. So we thought
Yeah.
this would be a perfect topic for everybody who's out there getting a little nervous about October and wondering if you should hedge. So, Chalk Talk today, kind of a layup right here. Should you get out of stocks in September to prepare for a notoriously risky October?
Oh yeah.
So that's your thought question. As again, we're getting this all the time in our Q&A classes. So let's start off with some October catastrophes. You mentioned crash of 87. Going way back, we had the panic of 1907, down 50% in just 3 weeks. Think about that. We had the
I
crash of
didn't even know that. Is that right? 1907, we were down 50%.
50%. Crash of 29, we had Black Thursday, down 11%. About a week later, we had Black Tuesday, down 12%. We had the crash of 87 down. Now, I know you know this one because you were on the floor, I believe, at that
I
time,
was
right?
there. I watched it happen. I was
You
in it.
watched it happen. That had to be an
I was
insane.
I was trying to swim and I was having trouble.
Oh, I can imagine. Yeah, I can only imagine.
That was
Those were all in October. Then, when we had the 2007 2008 financial panic, we started to get warning signs in '07, which is why it overlaps. We're not really exactly sure where this panic started, but we saw signs in '07. But October of '08 suffered the largest decline, almost 17%. So again, it's all of these things that happen in October, and everybody starts to put it together and they say, ah, I got it. Therefore, October is risky. For whatever reason, some kind of a cosmic connection with the universe that it just doesn't like October and I need to hedge. And that's what gave rise to the expression sell in May and go away. So this is usually attributed to the big Wall Street traders who go on vacation, summertime, that we typically get this slowdown and we just go away until, October. We start getting into the winter. And that's where people get this misconception. And can it be true? Of course it can be true. But like Stu said, there's lots of crashes in January and February and March, and they're all over.
Mhm.
But what happens is that there's a psychological bias. It's called the confirmation bias. And that's where once you have a belief, you start seeing more data that confirms your belief. And if there's anything to the contrary, you just disregard it. So anytime that something happens in October, you go, see, there's another time. October's risky. And if it happens in January, you don't even notice it. Or you go, oh, well, yeah, it can happen anytime, but October is especially risky. Even if nothing happens in October, you blow it off. It's only when the confirming things trigger that sensation that, hey, see, I'm right. So I think that's more of what it is, that there have just been so many landmark crashes that just happen to be in October that people think that it's always going to be true. So let's dig a little bit deeper about this idea and find why it might not really be all that risky. So before we do, remember marketrebellion.com/get started. We have all kinds of very cool articles and videos and topics just like this to help you make better decisions and stay calm when everybody else is in panic mode. So one of my favorite things, Stu, we talk about this a lot in our Q and A's, different statistical ideas and puzzles. And there's one that is statistics. It's called clustering. We're going to look at some examples, but uh, recently in an option school article, I used this exact graphic. And the question was, if you spill, let's say, a bunch of marbles on the floor, or I think I said even with Roscoe, some dry dog food, and it just scatters out everywhere. I want you to think about, would you expect it to scatter out like the graphic on the left? and be exactly equally spaced? Or would you expect there to be groupings, what we call clustering? So think about it. We dropped all these marbles on the floor. Would you expect it to look like this over here where they're all exactly equally spaced? Or should we get little clusters and then we get
That one,
some white spaces and
the one on
little
the right.
stragglers out here, but then we get big clusters?
Yeah.
This is far more. This is absolutely everyday occurrences. People would say, well, of course I would expect that. But then here's the trick. When we overlay it against something else, we no longer think of it as random. So if you look at this on the right, people say, well, that's random. I don't see any rhyme or reason to any of those dots. To me, that looks like there's no real pattern. But watch what happens if we take a map of the US and we place some dots on here. Let's say this is another break of some type of a viral outbreak. And the CDC publishes this map. People see this and what do they notice? Clustering. But they don't see it as clustering because we're programmed to find patterns. It's just something that people have done. It's a survival technique, uh, but we're programmed to look for patterns. Sometimes it helps, but in the stock market, it typically hurts. So, for example, you might look and say, wow, look at this, Stu. Maine is completely unaffected. So it must be something to do with the latitude or just that it's cold. Maybe the virus doesn't like seafood, saltwater air. Maine is also the most heavily forested state. Did you know that? In the entire US, maybe the virus doesn't like forests. Maybe it doesn't like lighthouses. But people will come up with stories that fit the data. And then people go, oh, that makes perfect sense. The virus doesn't like cold. It must be a fact. And you're going, no, it's not a fact. It was just a story that was designed to fit. Of course it fits. And then to further it, they'll say, well, look at this. Florida got hit hard, and Florida's the opposite of cold. So see, that kind of confirms my belief. And then maybe up here in Minnesota, we're seeing also something to do with the uh, the latitude up here, and in the Carolinas, looks like it's something about the cold or something about that, and people get fixated on this. But what's interesting to me is that because we have a map of the US and we have defined borders and we have names of the states, people start to see patterns. But watch what happens if we take that previous marble scattering picture and overlay it here. It's exactly the same picture. See, look at it. There's it, parts in the gray here don't change. All right, it's exactly the same picture. I just overlaid it, or I'm sorry, here I took it away, and then suddenly it looks like it has meaning. But if we did this without the US map behind it, we go, oh no, it's completely random. But then you put the US map on it, and go, oh no, 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 there's some patterns here. I can see them. And it becomes a race to who can find the most plausible story to fit the data. And then we say that's the reason that it occurred. And I think that's probably what's happening here with October, or at least it is something to consider. Rather than saying October is definitely risky, what do I do to hedge? All right, so think about this as we go forward. Quick reminder again, marketrebellion.com/get started. Truly, lots of great stuff on there, all free. So let's do a little example here with a coin flip. Let's say that we flip a coin 12 times, one for each month of the year. And heads is going to be, let's say, a positive return. Tails is going to be a negative return. In other words, a good month or a bad month. Now, the question for you, Stu, should we expect it to go heads, tails, and just completely alternate? Would you expect that if I flipped a coin right now 12 times? Probably not. Just like the marbles on the floor, that would be actually quite odd. And in fact, if you flip a coin 12 times, there's 4,096 different combinations that could occur. One of those will be all heads, very rare. Another will be all tails, very rare. Another will be perfectly, oh, I'm sorry, there'll be two that will be perfectly alternating. One will start with heads and one will start with tails. It will perfectly alternate. So there's 4 out of 4,096 that are either all heads, all tails, or perfectly alternating. So what should you expect? The only other choice is that you've got clustering. You can either say they're all heads, all tails, or alternate. But again, those are only four possibilities. So what's the most likely thing? Clustering. So here I did in an Excel sheet, and look at all the times that heads came up here. Three in a row, three tails in a row. Here we got five tails in a row. Here we got four H's skipped, and then another two, and then three tails. People usually find this hard to believe. And there's a thing in statistics, like a lot of teachers will do, they'll have the class write down 10 or 20 sequences of what they think is a random coin toss. And people tend to alternate too often. And so the trick is the teacher will look at that and say, that was, or I'm sorry, I think they could choose between either making it up or flipping a coin. And the teacher can tell instantly because there's too many alternations. And people don't, if they're doing it on their own, they don't think of getting five tails in a row. Most people wouldn't do that. Now, I know a lot of people would think this is cherry picked, so I brought the Excel sheet in here, Stu. So take a look at this. Here's our 12 months. And if I hit F9, it's going to flip a coin. So watch here. Do we have, that's actually almost, look at that, almost perfectly. Got two tails and two heads. But watch how many times we get, again, not a lot of, there's three and three. See if we can get five in here. But you start to see there's 1, 2, 3, 4. See, we tend, look at, there's five heads in a row. If I told you to make up a coin flip of 12 times, would you start out with five heads? See, most people wouldn't. And that's why it appears weird, because people just aren't really conditioned to understand what randomness looks like. There's lots of streaks. So this is why we have to be careful when we say, oh, I've gotten five winners in a row. Now I've got it all figured out. It's because I use MACD. See, I had these lots of hits and misses, but now I got five in a row. So now I know for sure it's this technical indicator. Probably not true. It's probably a clustering. It was just random chance and random noise. So we have to be aware of that. So I went and dug up some data here. This is going back to 1945. And if we look at the months here, look at that. February, kind of flat. August, kind of flat. September, down almost 0.75%, minus 0.72 on average. Now, obviously, that means there are sometimes it's good, sometimes it's negative, more or less. But overall, the average has been down. But look at October. What is it? Plus 0.91. So is that good or bad? Well, let's compare it to the other months. And what do we see? If we rank them from low to high, see, this is ranked chronologically here, but if we rank them from numerically, the median value that goes exactly halfway would be right between October and January. We'd have 1, 2, 3, 4, 5, 6 on the left and 1, 2, 3, 4, 5, 6 on the right. It's right, basically right there on the median.
That's incredible.
So why would you want to get out in one of the better months, or at least the median value?
Should I sell everything at the end of August to get away from September and
Exactly.
buy it in October?
Exactly. Now, if we also look back here, November, December are historically two of the best. So shouldn't you be buying in October? And maybe consider yourself lucky if October looked like this and we're getting ready for a very positive November, December. Now, again, I'm not going to say that November, December are going to be positive, but I'm saying that people who believe in this graphic here, or the sell in May and go away, or October is notoriously risky, forget about this. They're just focused on October. And they don't realize, first of all, overall, it's not risky. Yeah, we've had some hits. But again, I think it's that confirmation bias.
I have an idea, Bill.
Yeah.
So I'm looking. You probably see me look away here. I'm looking at my screen. I'm looking at the SPY end of September implied vols, and I'm looking at the October implied
Okay.
vol.
All right.
And the implied vols seem to be a little bit higher, maybe a tick or two higher in
Okay.
October. So I'm thinking to myself, well, maybe Bill's like, maybe he's off here. But then I took it to the next step and I said to myself, well, what's going on in October? So September is the end of the quarter, right?
Yeah.
And what do we have at the end of the quarter? We have earnings.
Hmm.
And we have end of the most of the time, it's unless it's a fiscal thing. We have the end of the year,
Hmm.
last quarter earnings, which are big.
Yeah.
And maybe some of this volatility that we think we see in October
Right.
is really attributed to an earnings release cycle.
There's a lot.
Look,
Exactly.
I don't, I'm not saying that's what it is. I'm just saying there's a world outside of
Right.
this. Oh, October is going to be down, and why the the options world is really good at getting a handle on what we think
Oh yeah.
is in line with an applied range. I mean, that's what prices of options really are.
That's right.
So when you look at something like this, it's like, oh yeah, you know what? But this is about range. So, I would say if I had to answer this on a test, I would say this is probably due to the earnings cycle,
Yeah.
or kind of take a look around and see what else is going on. This whole thing about October is a bad month. It
It's
feels
not
that
true.
way
Right.
because we lived things that we
That's
remember.
right.
Everybody
Hmm.
remembers the crash of '87.
Yeah. Right.
Everybody remembers the '08.
Right.
Um, who remember? I wonder who remembers like the what was it, the Russian currency thing in the late
Oh yeah.
'90s,
Right. Right. That was
98,
long-term capital management fault. Right.
that was in August. Well, how come we don't talk about
We
August?
don't talk about August.
How about, I don't know,
Again,
whatever.
we kind of sweep those under the rug because they don't stick with us.
Yeah,
In the option school article, I made an analogy where, like, if you always hit a red light, and you once you notice it, you go, "Gosh, I always hit this light red." Once you plant that thought, what happens? Every time you hit it green, you never think about it
yeah.
because
We
it's
do
not
have
there. But every time you catch it, you go, "See, I always hit this thing red." It's got to be almost 100% of the time that I hit this red,
happens all
and
the
it's
time.
probably not true. It just feels like it.
Feels like it. I'm a car guy. I kind of like, when I see a vehicle that I like, and maybe it's I don't know, the Burgundy Vet, the new model Burgundy Vet. I thought it was really a kind of a hot looking car. And then, as I'm driving around, I was like, man, look at that. There it is again. And there it is again. But before I never even thought about it. Right. I mean, like, who's looking at that?
Yeah,
So yeah, I mean, it just gets ingrained in our head that, there
right.
it is. This is really interesting. And Bill's
So
doing the math. I mean, this is it. This is going back how many
this is
years,
it,
Bill?
right? Here's the data. And again, now it would be different if these were all tens and twelves, which would be incredible for a month. But I'm just saying that if these were really
Yeah.
large numbers and this was really low, you might say it's not such a hot month, but it's not. It's right in the middle. It's
Yeah.
basically the median value. Why would you, if there's anything you're shooting for in the market, it's the average or the median. It's a great month.
Yeah. I mean, this
Now,
data suggests you got to be a buyer in September, and certainly a buyer into October. I mean, if you go by the whole chart thing, wait for the turn. Well, the turn came in September, and now you're on the uptick in October to buy into November and December. I mean, that's what the data is telling me right here.
exactly. I'm trying to find, there it is. So again, it's this whole idea that people like to come up with stories that fit the data. Don't forget that. The reason that the stories sound good is because they're designed to sound good. We have people like that said it's the earning cycles or it's the mutual funds that are selling for tax reasons and for tax harvesting, and they go, "Oh, well, that's got to be the answer." They never stop to think it could be a complete fluke, random noise. It's just that instead of seeing marbles on the floor, we're overlaying it on a map. Here we're overlaying it on a calendar. It has names, it has borders, just like the US. And we say, oh, see, there's something unusual about October when it could be just noise. Now I'm going to bring up one other chart, which we've talked about before. This is a fair value of a coin flip, at least for the way that I have it here. But look at when I hit F9. This is a coin flip. And people again they kind of think that it would just go back and forth. But look at those streaks. And wouldn't it be very easy to talk about a flat line right here? Or, oh, this is when uh, Powell was speaking and the markets didn't like it because if the rates go up, this company's not going to make as much money. Because that's exactly when Powell spoke. That's what caused it. You're like, well, not really. It could have been just complete noise that you're just lining up a story that sound kind of makes sense, and then people say it must be true.
Yeah.
Or this guy must really know markets because look at him explain all of these nuances.
I'm
But
looking
if
at
we go,
this chart. I see at least in that chart, I saw at least four flat lines in that chart,
of
which
course, everybody will. And actually, if you want to go further, you will get perfect Fibonacci retracements. You'll get, I mean, look at this. You'll get head and shoulders, lots
hey,
of head
that's
and shoulders.
a
There's
beautiful
lots of
flat
head
line.
and shoulders in there. Look at these
Yeah.
flat lines. And we can say, look, here's 1, 2, 3, 4, 5, 6.
You
That
go
is
back to
not
the
a
other side.
coincidence.
It's a swing
That's not a
low.
coincidence. Yes, it
Look,
is.
look at the swing low on the left. It's the same as the swing highs on the right that you just pointed all the way
Exactly.
to.
There's all kinds of patterns in here.
Yeah.
All kinds. And if you look at this and go, it kind of looks like a stock chart, you'll see why, statistically speaking, the price changes are random. Now, that doesn't mean, and you have to be careful here, that doesn't mean that people get up and just start flipping coins haphazardly about what to buy and sell. They have very real reasons for doing it. But because there's so many different reasons and rationales and timing, it's going to behave as if it's random. That's the difference. So that's why some people say no, markets aren't random. People are following the news, they're trying to make money, they're reading the charts. Okay, fine, but it still behaves as if it's random.
Or
So
it's the
the
market
point
maker.
is that yes, you can come up with all kinds of stories that would fit this data. Just go back in the news and see what was going on at this time. Might be, sunspot data, might be full moon, it might be this is the date that there's always going to be something in there. Find the one that's most plausible and they'll say that's what caused it.
Bill, I know what the answer is to every issue and problem that occurs in the market.
What's that?
Market makers.
that's there's a exactly right. When you can't explain it, you just blame it's not my fault. It must be the market makers.
The
Right.
market makers are the cause of all evil, the root
That's
of
another
all.
psychological bias. We say I can't explain it. It's not me. Right. I bought at 80% vol going into Nvidia earnings. The stock was up. I'm right. How come I lost on my calls? Well, that's
Yeah.
not understanding implied volatility. And if you ask these new traders, they'll go, what? Oh, see, it must be the market makers. The market makers just drop the prices. But that's what happens. That's how a lot of these myths and misperceptions come into being. So anyway, this is actually a good exercise for those who can do this in Excel or maybe go to Chat GPT and have it throw some random coin flips. This is for 10,000 flips. Look at that downturn. Can you see this too? Some people would say there's no way this is random. I mean,
That looks
right
like
up into
our
here was right when the interest rates peaked, and then right there's when Powell cut them, and that is absolutely what caused it. And the more I pound the table, people say, "Well, yeah, that's kind of what caused." I look at that and go, "I'm not sure. I'm not sure." Because I
Bill.
understand, at least better than most, what randomness looks like or could look like.
Bill, I think did you copy that from our Clorox chart?
Exactly. Well, you know that Clorox is a good example. People go, "Why is it doing this? Why did this chart do this here, Stu?" Don't know. Clorox could be nothing more than it's just a convergence of everybody selling at the same time, triggering more sell orders, creating positive feedback loops where everybody's selling just because everybody's selling. There might not really be a reason. And that's a hard thing to accept for a lot of people. They all want to have a reason because if you can put a reason to it, it seems like we're more in control. Seems like it's not as risky to go into the markets because I know why this is moving the way that it is. So the main thing to understand, though, here I didn't forgot I had this slide here for the confirmation bias. Again, it's a tendency to interpret information that confirms your belief. So I think that's more of what October is. Every time we get a whiff of anything that's negative that just happens to be in October or even very close, That's another psychological bias. Well, it wasn't really October, it was end of September, so close enough. Well, now you're starting to make a much bigger window of things that are qualified. It's the beginning of November, but you know what? Close enough to October. It's October. And that's really, I think, what happens more often than not. So, one of my favorite quotes now, think back about when Mark Twain was around. Even he knew that October was risky. It's fascinating. But I love this quote. He says, October, this is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. And I think that's probably the best way to think about October being risky. They can, like Stu said, we've had things in every single one of these months,
every month.
but
It's
we
always
don't,
something,
we just don't remember them.
always something.
So hopefully we like to bring that up, especially for the new traders who are thinking, gee, now that I understand options, what can I do to hedge for October? The
Yeah,
answer
well,
is probably nothing.
just
Let
you
it go.
gotta understand what's going on, how the options work, what they are, what they do, what the cogs in the wheel are doing. And once you understand the theory behind what they do, it's a lot easier to kind of figure out what you want to
And
do.
make better decisions.
Make it
Exactly.
better.
So, should you get out of stocks in September to prepare for a notoriously risky October? What do you think, Stu?
Negative.
Normally, our answer is depends for everybody who knows. I'd say the same thing. I'd say if you do, you're going to be lucky just to break even. It's going to get priced in there, but chances are just as good a chance it could be up. And statistically, that is the better way to bet. So anyway, this will be some good information to fall back on. We'll come back in maybe in
And,
November,
and look,
take a look
everybody,
at it.
should you get out of stocks in September? Well, maybe, if you got something to do in October and need the money, maybe you should. But
Yeah, not just because you
you
think it's going
prepare
down.
for it. So the notoriously risky October, that doesn't really exist. See, we made that up, right?
I was going to point that out, and I think that's why I've highlighted it in red. Is it notoriously risky?
Yeah,
Yes,
no,
it does. Well, again, it has that reputation.
yeah, right.
That is true, but is it statistically true? It is not.
I suggest no.
It just isn't. So again, keep your head through October. There's no reason to go out and do whatever, buying puts or doing collars or whatever you want to do to try to hedge it. It's the
Or that,
risk that you
or
signed
that
up for.
that you think is there, which not isn't really there.
Right. It could be, but so could any other month. If you're going to
Yeah.
be a long-term investor, ride through it. If you get some dips, if anything, use it as a way to accumulate, but don't try to time it, especially based on this false belief that October is notoriously risky. It's just not true. So we want to thank you for joining us. Hopefully you picked up some good tips, and we'll look for you next Thursday on Coach's Corner, and we'll see you then.